Hey everyone, how's it going? We just got the closing bell for November 7th, and today we had the FOMC meeting. We had Powell's comments afterwards, and really it's probably the most boring, most muted reaction that we've seen for a long time, maybe even since COVID. I can't remember seeing anything, the markets react less in the last few years. So let's take a quick look at that. On the S&P, we can see that at 11 o'clock, yes, we did start to get larger bars, but we didn't have any initial reaction. Powell was done speaking by 12. We didn't have a huge reaction. So all it did was basically just resume what it was doing earlier. We opened gapping up and basically stayed above the VWAP. So bulls are definitely in control today, but not super strongly in control. Where did we end up? We ended up at about 595 and a half. We opened at around 593. So we went up about 2.4 during the day, which really isn't that much. It's maybe 1/3 or not even 1/3 of an ATR, maybe about 1/3 of an ATR. And today the overall S&P 500 was up 4.5. So that means that basically half the move happened on the gap up and the other half happened during the day. What does that mean? That does mean that we do have some strong momentum in the S&P 500, but can it continue? And in the medium term, the answer is absolutely yes. Over a couple of weeks, over a month, yeah, that can continue. But this sort of gap up followed by another gap up, you can see that this second gap up is already much smaller. So for it to continue to move in that direction is very unlikely. We went over this yesterday, where when we have such a huge move upwards, there does need to be some sort of pullback or consolidation period before we get ready to move once again. So is it going to chop sideways or is it going to pull back? That's debatable, but we can maybe look at a few things to see if we can get a clue. So let's see if we can get some examples over here. Gap up sideways for a couple days before resuming upwards. Gap up, a second gap up, then sideways for a couple days before moving upwards. Gap up, chopping sideways for several days. Gap up, pull back to the EMA 8. I'm looking for gap ups. Gap up, chop sideways for 3 days before resuming. So it's not normal for us to really see gap up, then gap up, then gap up. Here we did gap up, then gap up, but then we went sideways. So let's see if there's another example here. 2 gap downs and then a recovery, then a bounce, right? Gap up, then a 1 day sideways movement, and then a resumption, but then sideways movement for several days. So you can see that generally after we gap up, we do need at least a little bit of a pullback or sideways movement before we can strongly resume trading higher. So that's what we're going to look for. We're not going to expect the S&P 500 to just go wild and go crazy tomorrow or Monday without at least pausing and pulling back. What that means is that if you want to go long any stocks, you should probably wait, because either you're going to get caught in a chop sideways or you're going to get caught in a pullback and you would have gotten a better entry. And in case of options, even if it's just a chop sideways, you're waiting a little bit longer, you're paying for time value. So it's better to just see the consolidation actually happen, or see evidence that everything is going to be super strong. One of the things that we look for in terms of evidence is, are all the sectors moving up at the same time? Do we have high risk, medium risk, low risk stacks of our sectors? And yesterday the answer was no. We had some sectors that were clearly down. And so we'll take a look at the same thing today. So that indicates that we're probably going to get at least that consolidating sideways movement, if not a mild pullback to the EMA 8. So let's take a look at our other major indices. S&P, yes, made a new all-time high today, did gap up today, is up 0.76%. How about QQQ? QQQ up 1.59%, which is right about actually a little bit above its ATR. So it did gap up and then gap up and run again today. So that is a little bit of an unusual situation. So I'm definitely not going to expect the QQQ to keep on doing this. Remember, we're talking about large ETFs. A stock might be able to do it and sustain it for a few days or a week or so, but an ETF, a large ETF with huge large cap stocks, that would imply that all the stocks, or a huge significant number of the stocks inside of that ETF is exhibiting the same behavior. And that's just not too likely for a whole slew of these stocks to be doing the exact same thing without some sort of huge catalyst. And yeah, we had an election yesterday, but it's over now. People know about it. So there's no real reason for this to keep on going for multiple days. So we are going to look for a pullback or sideways chop in the QQQ as well. QQQ did make a new all-time high after actually yesterday made a new all-time high. I thought it didn't quite make it, but it actually did. And then today, an even higher all-time high. How about the Dow Jones? Oops, Dow Jones. And now we start to see a little bit of a breakdown. The Dow Jones just chopped sideways. It's only up 0.03%, which is basically zero. It chopped sideways, so we're not seeing the same strength in the Dow Jones stocks, the blue chip stocks, the lower risk stocks. So our picture or our argument for us to be able to just keep on running without some sort of pullback or consolidation, it's starting to fall apart with this Dow Jones exhibiting that weakness, a doji candle right there. And the Dow Jones now is more likely to have that pullback than the QQQ or the S&P. It could still chop sideways as well, but because it's exhibiting relative weakness, then it's a little bit more likely than the other two to have that pullback. Let's check out IWM. So is it just that we have high risk or low risk, or high risk, medium risk, low risk in terms of QQQ, SPY, Dow Jones, and in which case we do have a nice stack? Or is there a deeper picture? So what else can we look at? We can look at IWM, which is even higher risk than the QQQ. So if IWM gapped up as well and went even higher, at least as much as the QQQ did, then we're starting to see a story, and what we might be saying, hey, okay, well, maybe it could start running again. Let's take a look at IWM, and no, that did not happen. It looks actually a lot like Dow Jones, except maybe a little bit weaker than the Dow Jones, which is interesting because the Dow Jones and the IWM are at opposite sides of the spectrum. So we are down 0.38%, mostly chopped sideways, but a little somewhat significant, more significant, obviously, than the 0.03% in the Dow Jones. So this is definitely looking like it is more likely than even the Dow Jones to have that pullback into EMA 8. And the other interesting thing is, I don't think it made an all-time high. Yeah, it didn't make an all-time high, even with the stimulus of the election results, whereas the QQQ and the S&P did. So if we want a true bull market, a bull market that just keeps on going and all the stocks rise with it, where you don't have to be a great stock picker and you can just pick anything and it goes up, then we want the IWM leading the QQQ, leading the S&P 500. And that's not what we're getting right now. So again, it does look like the IWM and Dow Jones are more likely to start pulling back, at least for a few days here, until we get some sort of support either over here around the 228 to 228.5, or I guess 226.5 to 228.5 region, which would put us near that EMA 8. That would be appropriate pullback. And then if the IWM could bounce from there, then we could resume higher. Let's take a look if we have a similar story in our sectors. So I'm going to go over here to our sector scan, and let me make sure that this is up to date. And just in terms of a longer term, let's not look at a longer term outlook. What we want to do is look at a 2-day and 1 day. So today and yesterday, because that's when the big event happened, the big catalyst happened. So let's just remind ourselves yesterday we had financials, industrials and energies at the top, followed by consumer discretionary. And at the bottom, we had real estate, utilities, and staples, and home builders and healthcare. So let's go to today. Now we have tech, consumer discretionary still up there, then real estate and communications. That's interesting. So real estate shot up from being unfavored yesterday to being a little bit more favored today. And let's see, at the bottom, we've got financials, the opposite of yesterday. The defense, industrials, also opposite of yesterday. Energy, also opposite of yesterday. So we've got this balancing effect from yesterday. So that's not great news for resuming upwards. If we had true momentum in the sectors, then the same ones would still be leading. The only one we saw that with really was XLY. So we'll take a look at that one a little bit more carefully in just a moment. But everything else kind of got jumbled up. Utilities went up a little, staples went up a little, so to more middle of the pack. And let's see over the last 2 days. Okay, over the last 2 days, discretionary did very well, not surprising because it showed up on both lists yesterday and today. XLK, technology and financials, despite it being kind of down today, is still actually this where am I sorted correctly? Yeah, I'm sorted correctly. Yeah, so despite it being down today, it's still one of the top performers. So it looks like it probably didn't pull back that much. Let's look at XLF. Yeah, so it just went back to where we gapped, or the low of yesterday. So it lost, but didn't lose that much. It lost within the range of yesterday. Okay, so right now, the most interesting thing to me that happened was in XLY. We'll want to take a look at that a little bit more carefully. And these safer havens had money come out of it, but they have recovered today. So again, a little bit of a balancing effect. That enthusiasm that we saw yesterday just isn't sticking and staying into today, with maybe the exception of XLY. So we are going to expect that at the very least, our major indices are going to chop sideways, if not pull back a little. Let's take a look at XLY more carefully. So it did gap up and move higher, and then baby gap up and then strong move higher today. Today it was up 2.69 on a 3.27 ATR, so less than 1 ATR. That's more within kind of random movement upwards. So it is the most interesting sector at the moment, but even the XLY, we would say, probably not going to keep on shooting up like this, maybe a little bit sideways. So let's take a look at maybe some of the top stocks in XLY, just in case they become interesting. And if we do get an overall market pullback and associated pullback with XLY, then we may get some good entries for these consumer discretionary stocks. Or if they don't pull back, or some of the strongest ones don't pull back, they just go sideways a little bit, or even they move up a tiny bit. Well, when the market bounces back, those are going to be great stocks to be in. So let's take a quick look at that. Okay. Okay, looks like Royal Caribbean, quite strong. It's Carnival Cruise Lines, so 2 cruise lines. Tesla, I would be careful. Yes, it did move higher. However, there's a few interesting things about Tesla. Number one, why did it move? Well, it moved with everything else. Okay, great. Why did it continue to move? So there's no fundamental reason. For all of these, there's no real fundamental reason unless there's a true benefit to the a certain president or Trump coming into office and providing benefit to those sectors. So, for example, RCL and CCL, well, do people have more money under a Trump administration to spend on things like going on cruises, or does the inputs into these industries, do they get cheaper? For example, oil and gas or diesel, whatever fuel they run on, fossil fuels, do they become cheaper under Trump? Then yeah, maybe. Yeah, at least that's the expectation. So these two do have some sort of fundamental reason where, yeah, we can say that under our analysis, maybe they will benefit and continue going upwards. But what about Tesla? Tesla is an electric vehicle and should be in the category of alternative energy or electric energy. And that has been doing very poorly. So fundamentally, there's not the same reason to believe in Tesla. And so we would expect this to pull back down because it is just riding on the fact that Elon was a Trump supporter and looks like he may get a government position. Now, the other tricky thing about Tesla is if Elon Musk does get a position in the government, typically these guys, the commissioners of whatever, the secretaries of whatever, typically they're required to divest themselves of all or a significant portion of the stocks that they own. So if Elon gets forced to sell a bunch of shares of Tesla, then we're flooding the market. And the other thing is, as a kind of bandage to the wound of being forced to sell their stocks, oftentimes these government officials, since they were forced to sell their stocks, they get a tax benefit. Their sale becomes tax exempt if they have profit in it. So Elon, if he suddenly has hundreds of billions of dollars tax free, that's probably not going to make the markets too happy with Tesla. And so there's a good argument against Tesla resuming and continuing to fly upwards for a while. We'll see. We'll see how that plays out. In any case, the moral of the story is, for now, personally, unless I'm trading very short term, I would avoid Tesla. Let's take a look. Garmin. Garmin's looking great. Another cruise line over here. VFC is looking good. And booking.com. So it looks like travel is expected to continue to do well. Of the cruise lines, you would just pick one. You wouldn't want to be in too many. And you might even just pick one between Booking and the cruise lines, because they are in a very related industry and you wouldn't want to double up or triple up on your exposure. Garmin is looking pretty good. Probably my favorite out of all of these. But on all of them, they did gap up. I would wait for a pullback before considering these. But of course, if the market pulls back and they stay higher, or they just chop sideways, then they're relatively strong and they make a great pick as well. Okay, so I think that's going to be it for today. We have a momentum in the markets to go higher, but realistically, they do need to pause or pull back before they can continue significantly higher. So we'll see how it plays out. Maybe I'm wrong and they just keep on running, but it's pretty unlikely. There was a run earlier this year. I think it was 8 days in a row in the S&P 500, and that was pretty unusual. A higher 1, 2, 3, 4, 5, 6, 7, 8. Looks like 8 or 9 right here. So yeah, maybe we could get that on, but for it to happen on a single event, on a single binary event like an election result, it's probably not. This usually happens on a broad policy change, although you could argue that a new president does probably mean a broad policy change, but it's not happening right now. It's happening in several months. A lot of things can happen in between now and then. And yes, markets do start to price in the future, but I think in this case, because we saw that divergence between the Dow Jones and the IWM versus the QQQ and the SPY, and also this divergence between sectors. And none of the sectors except for consumer discretionary resumed their momentum upwards 2 days in a row, then that is an argument that it's more likely that the markets are going to chop sideways or even pull back mildly. So we're not going to position ourselves to just for a big run. We would wait for that pause or pull back before you decided to enter into a long position. Okay, that's it for today. Have a wonderful rest of your day, and I will see you tomorrow.